What is really going on, crypto savages? You are listening to the CoinSpice podcast with host C. Edward Kelso, editor-in-chief at CoinSpice.io, your home for spicy crypto things on the net.
So, all right, this is a long time coming. It's very difficult to get Mark Lamb of CoinFlex on. He's a busy dude in Hong Kong, and we were one of the first outlets, I think second only to Bloomberg, on the fateful day that he launched a few months back, to have him on. So it's a real honor that you come back on and kind of share the updates and all that good stuff. But thanks very much for doing this, Mark. We really appreciate it.
Yeah, absolutely. Always a big fan of CoinSpice. Very
cool. So CoinFlex is a physically settled futures exchange, and that's quite a mouthful, but I think it's probably best to kind of start off with, well, the basic idea of speculation, which when we're on the currency side of things, we're all about, commerce and peer-to-peer cash, and exchanges and stuff are if I wouldn't say they're the enemy, but they're sort of talked down on as if they're peripheral to the, sort of the point of things like Bitcoin. And I think we're now starting to be disabused of that because exchanges are not only ubiquitous, but in the news game, I can't stop covering them. So if everybody's not interested in them, I don't know why the hell we're talking about them all the time, because obviously they're very, very, very important, especially now to the ecosystem. But why do you think, before we get into futures specifically and sort of the derivatives idea, why do you think speculation, kind of that ranked term, which I know roils some traders and people, why do you think it gets such a bad name? Or I guess maybe a better question is, why do you think it's important?
Well, yeah, speculation is extremely important. I think, there's always this difference between short-term traders and long-term traders. And a lot of people blame speculators, or in some cases they blame short sellers when the price does something that they just don't want it to do. So people who, own a lot of an asset might not like short sellers or speculators who drive a price, they maybe seem to be driving a price down by selling lots of it or even selling lots of it that they don't have. It kind of makes sense that people would be angry with these people, but really it's providing liquidity. And the beautiful thing about the market is if someone's doing something you disagree with, and you have the capital to back it up, you can take the other side of that trade, and you can say, well, you've driven the price down to a level which I don't think makes any sense. I'm going to buy a bunch from you, and the best traders win. And so this is where it's just one of those things that over time markets become more efficient, markets become more liquid, and any speculator is, there's one way to think about it, which is that they're basically just, degenerates or whatever. But There's another way to think about it, which is in the same way an academic puts his thesis into a committee and, eventually it might go into a textbook or something. And in the same way an engineer might have an idea and eventually it creates a car. Speculation is sort of a process of invention that's very quickly followed by a process of testing that thesis in the real world in almost real time, and pretty quickly getting proven right or wrong day in, day out. So, the best traders, they're very creative. They're very fast on their feet. They think actively, and they're just testing ideas out. They're testing things out and seeing the results of those tests basically in real time. So I think it's a beautifully inventive process, and it's exciting and it's fun. And the good thing is it's not just luck. There's skill involved as well, and there is actually an ability that some people have to outperform the market or to do well, and in some cases you can make a living or make fantastic amounts of money or what have you. And so that's the benefit of it, and any holder benefits from it as well, because the more speculators make money from volatility, and you can't make money from volatility and also increase volatility. So anyone who makes money from volatility is actually reducing it. They're dampening the swings, and they're providing liquidity to the buyers and sellers. And so this liquidity is what holders are able to be confident in, because they can say, well, I know that I can always get out, so it makes me more confident to hold. And it's very, very key.
That's
that they're
really interesting.
Yeah. Yeah, so that's how I think of speculation. I think it's a beautiful thing. It's existed for all time. It will continue to exist for all time, and it makes markets amazing.
And it seems to me something that I think we might have talked about this before, that many in the space hadn't really anticipated, and now it is. I mean, arguably, it is the liquidity arm. If I describe it as one thing, for the entire space. So if you want to point to how your project is doing, there's a green number and there's a red number, or an arrow, or whatever, or a market cap, or a price, or whatever you want to focus on. So I think exchanges are for better, for worse, or whatever, they're a reality, and as you say, they serve a really legitimate purpose. And I love the skin in the game aspect that you're pointing to. That this is no longer just theory, but they're actually in there. And so, taking that a little bit further, futures and I guess derivatives, if I lump them together, which probably is a mistake, those are even, especially derivatives, that's just, it's almost like a cuss word in the United States. I mean, it's supposedly responsible for all the bad things that have ever happened financially. But I've heard you talk about it before. Can you go into a little bit about futures and derivatives and why they're important?
Sure. So derivatives solve real world problems that people have. It's very, very important. There are bad derivatives out there. There are problematic derivatives out there. In fact, there's a great book I read by Richard Sandor, who's been on the board of practically every exchange out there, and very, very influential in the traditional future space. And it's one of my favorite books about futures. Is a book called Good Derivatives, and it talks about it's mostly about futures, and it just talks and it goes back from interest rate futures to commodity futures, all sorts of things. And it's mostly just this guy who's been in the exchange game for his whole career, and just different stories of his and how he thinks about derivatives. But derivatives basically solve problems where one company or one individual or one player in a market has some risk that they want to change, or they maybe want to obtain some risk. I always want to be long crypto, right? One way for me to do that is to buy a bunch of Bitcoin Cash, Ethereum. Another way for me to do that is to buy futures on these assets. And depending on my situation, it may make more sense for me to buy these in derivatives markets rather than in spot markets. There might be miners, or there might be other players, commercial firms, trading firms, other types of firms that may have a natural reason to sell Bitcoin futures. And lending and borrowing and payment processing are also a big, big component of the space. But the example people always give is the corn futures markets. So back in the day, corn farmer didn't know where the price of corn would be in 6 months or 9 months, so they would sell some corn futures, and speculators would buy them up because they thought, oh, this is maybe cheap, or maybe corn's going to go up, and there'd be players that actually needed corn, and so in some scenarios, most of the sellers go to speculators, and most of the buyers go to speculators. Sometimes sellers and buyers interact with each other directly. Kellogg's needs corn for cereal, and then farming companies need to sell corn to get cash. So they trade in these physically delivered corn futures markets. And we're just basically trying to do that for Bitcoin. Most people will not go to delivery. So delivery is this concept where at the end of the futures contract, which is the end of every month, there's a delivery mechanism that happens. And for CoinFlex, it's physically delivered. So what that means is longs, anyone who buying contracts receives a Bitcoin. Anyone who's selling contracts delivers Bitcoin and receives Tether. Most contracts, most people will not actually go to expiry, go to delivery. But the ability to go to delivery is very, very key, because it means that these contracts can be used for all sorts of real world use cases, and it ties the contracts into the real world. So it's very, very exciting for adoption of crypto.
And it also helps with, I don't want to call it cheating. That's such a base, accusation, but there is some thought. And I'm trying to think of the example. There was like a swing, fairly recently in the last few months, where on an exchange, some whale went in and just, sold a bunch or gobbled up a bunch of Bitcoin and slammed the price. And then, I mean, that's all fair in love and war, but that's more likely, right, in a non-physically settled environment, right?
Yeah, you can call it like it is. People have said this. People are accusing it of being market manipulation, and that's the accusation. We don't know if it's actually market manipulation, but
right.
Most of the traders I talk to agree that it is. It's basically when you have a cash settled futures contract, it references a spot price, but it references that spot price on maybe 2, maybe 4. Maybe loads of exchanges. It actually doesn't matter the number. There's problems with small numbers and there's problems with big numbers. But it references some number of spot exchanges. Well, derivatives open interest, which is the number of outstanding derivatives contracts at any one time, is usually huge. And there's not that many people that need to go and buy physical spot Bitcoins at any one point in time. So the spot markets are not super active. Derivatives markets are more active. But what's even more active than just the volumes of derivatives markets is the amount of open interest is often, could be enormous. It could be equal to the volume in the entire day.
So when you say open interest, are you yet at the sort of the difference between the prices of exchanges, or have I skipped over a step?
Oh, sorry. So open interest is the amount of outstanding contracts. So if I buy a contract from you, and you sell it to me, we've created one contract of open interest. So this is kind of the amount of Bitcoins worth of contracts, or the amount of dollars worth of contracts in outstanding positions in the system. So I might have if someone's a manipulator, what they would do is they would take a very large short or a very large long position in the futures markets or the perpetual swap markets. And then they would go on the spot exchanges, and they might take that out slowly through the course of the day, but it could be a huge position. It could be $40 million. And then they'd go to the spot exchanges and just sell those prices down, sell every single bid down to very, very low prices. And since the derivatives reference those spot prices, there's nothing, they're going to get all the P&L from being short in those futures markets and just having moved the price almost effortlessly. It costs some money, but
and the P&L is profit and loss. So they slam that price down. Are they in the case of maybe a short? Are they then waiting to then reaccumulate, buy back up?
They could have stacked bids in the order book down near where they're planning to sell it down to. So they don't even have to wait to buy it back up. They might be the bids that are buying it back up.
Right.
Beforehand. Yeah. Why wait for the order book to lag when you can just have your orders left in the order book there? So this is not that complicated. This is not like, you don't have to be a quant to realize how to do this. It helps to be a quant to execute it, but there's probably 100 or 1,000 players in the world that could do these types of strategies, and there's absolutely nothing stopping these Bitcoin exchanges from having these strategies. In many cases, in all cases, the spot markets are different from the derivatives markets, and I'm sure they're not willing to share their customer data with each other, so they have no idea who's doing it. you only know I was short, I was long, okay, but so were 10,000 other people.
Mm-hmm.
And if the manipulator is smart, they're going to split it up between accounts.
Right. I was just thinking that.
So it's impossible to prevent unless you do physically delivered futures.
Boom, and that's where CoinFlex comes in.
Yeah. So it's a simple one. We just don't price based off of spot exchange. We don't have this oracle problem that these other exchanges have.
And this becomes especially useful, again, as I explained before we went on, and again, you are familiar with CoinSpice. We're all about the use of cryptocurrency as peer-to-peer digital cash in the real world, solving real problems. So not this sort of, either wash trading example or just kind of shoving it between each other back and forth as a sort of greater fool idea, but actually used by merchants and commerce. And this is something that really caught me off guard. And I can't remember, but I know it was you. And I can't remember where you said it, which I guess doesn't really matter at this point. But you did say something about this having physically settled futures has a real positive, or I guess anti-volatility notion for merchants, right?
Yeah, absolutely. I remember where I said it. I said it on your podcast. The day we announced the spinoff. So yeah, no, I remember saying that. Basically, the core concept is pretty simple, which is a lot of the magic of crypto is truly captured when you don't leave crypto. So people are always like, merchant adoption of Bitcoin, where you can get Bitcoin but not deal with the volatility and just cash out straight into dollars.
Mm-hmm. And there's people actually who go in to do adoption stuff and to get the merchants to agree if they're hesitant, and they just sort of underwrite things, and they just basically let them dump out into fiat, right?
Which is logical for the business. The business does not want to be long crypto, and they shouldn't be long crypto. But and to be clear, I'm a huge fan of BitPay. They've done amazing work for the space.
Sure.
But there is this other thing you can do, which is allow the merchants to just short futures anytime they receive Bitcoin, and then they can hold the Bitcoin, short the futures contracts, and anytime they're paying, and then they can use the Bitcoin to pay salaries. There's actually a lot of companies now that are taking in Bitcoin or Bitcoin Cash or Ethereum or different cryptos and just not selling them, and they want to use them because it's very useful to make payments around the world, but they're exposed to this massive volatility. So why don't we get them to take in BCH, take in BTC, whatever, and then short futures contracts, and then when they're paying, when they're making the payout to an employee or a supplier, or paying those Bitcoin off, they just buy back the futures. And so the whole time they never have any exposure to the price, but they get this asset which has the ability for them to be effectively a price stable crypto asset that they can send anywhere with very little fees and almost instantly, kind of the promise of of Bitcoin, the original promise of Bitcoin, which right now is held true in Bitcoin Cash.
And I'm so glad you put it that way, because now we're full circle, right? We're coming. So people were very upset or scared or poo-pooed the exchange idea and speculation and the furthering down the road of things like futures. And now here it is. The irony of all ironies is that it could be that futures themselves, physically settled ones, are that link we needed to close the loop to make a cryptocurrency-based economy realer. I'm not sure how to phrase that.
Well, again, it's going back to this basic idea, which is commercial adoption, real-world usage doesn't work without speculation. you want to be able to use Bitcoin, you need to be able to buy and sell it for cash. If you want to be able to do that, you need speculators. This idea that every buyer can be matched with a seller that naturally, is merchant related or wants to sell at that point in time, it's completely insane. That's never been the situation in financial markets or markets generally, and it's not going to be. So
it is amazing how naive we are.
Well, everyone is. I was too, and this is the beautiful thing about this space is it's always a learning process for all of us. I understand Schnorr's signatures. There's so many parts of crypto I don't understand, and there's a lot of parts of crypto I do understand that I can explain to other people, and so we're all just learning things.
Very, very, very cool. I love how you explain things, and it clears a lot, especially for me, in making sense of your work and why it's so important. So since we've spoken, you guys have actually launched your own token now with the advent of the Simple Ledger protocol on Bitcoin Cash, and I may be stepping on some of your toes a little bit here, but why a flex coin or a flex token? And is that sort of your answer to the Binance BNB idea, or kind of take us through your thought process there?
Well, absolutely. So one thing is, I think there's a lot of exchange coins out there that don't really make sense. So some of these coins, if you actually look at them, the discounts fade away after years or something like that, and really at the end, in a few years, there are a lot of exchange tokens which the exchange might be super valuable, but the token might have actually gone to zero by that time. So or might not be worth very much. So CoinFlex, we've created this exchange token, and I think it's very important to note, it's not a get rich quick scheme. We didn't sell any to investors.
It's not an ICO, right?
It's not an ICO, exactly. So it's not at all a fundraising mechanism for CoinFlex. What it is basically an incentive for traders to join the platform. And I do think the origins of this kind of go back 150 years to the CME, where a lot of their early traders basically got cheap shares in the exchange, and you're
talking about the Chicago Mercantile Exchange, right?
Yeah, it was typically, it's been for most of its history, it was actually a members owned exchange. So it wasn't it was something sort of different from a private company with limited by shares. It was something different from a public company, which is what it is now. And it was kind of a trader owned exchange, and that worked really well. And CoinFlex, we're obviously, we have shareholders. We're not a members owned company, but we do want to create something which is relatively friendly to our early adopters. And so what FlexCoin is basically, it's a trade-driven mining token, and it's the first taker-driven mining token. So there's been a few attempts at trade-driven mining before. Most haven't worked out very well. There's a few problems why they haven't worked out, and I could go into that at length. But one of the problems is, in the long term, even if the exchange succeeds, there's mechanisms for the actual value to not be in the token, and the token value to just go down. So that includes things like dividends, that includes things like the fee discounts going away after 5 years, that includes various different things. But high level, that was one of the problems. Another problem is they paid both sides of the trade, so it became very easy to wash trade on these exchanges. We pay out. So 70% of the Flex coins will be issued to traders over the first 2 years of CoinFlex's existence. And basically it's paid out to takers. So it's not paid out to market makers, it's paid out to takers on the platform, because a lot of our shareholders are actually market makers themselves, and we really want to get takers involved. And that's we also only want to pay one side of the trade, because if you pay both sides, you basically encourage wash trading. So we've got a wide tick size, $1, and we have this incentive mechanism that incentivizes takers to actually trade. And so far, it's gone really well. It kind of, launched, started trading in the market, 15 cents, 18 cents. It's one of the things I'm pretty proud about is it's not been like pumped too hard, or it's not gone crazy. It's been pretty stable, pretty steady. I think the volatility has been lower than almost all the other stable coins in existence. So all the other exchange coins in existence. So that's been a big accomplishment. And yeah, it's just been steadily rising. So because of the model, the economic model is basically you can spend 100 flex and get 50% off of a day's trading fees. So it's very appealing to traders, especially large traders, because they know, well, if my fees are, a couple $100 a day, I can spend, or $1,000 a day or whatever, I can spend 100 flex, and basically I'm redeeming flex coin at effectively a couple dollars or $5 or $10 per flex coin. So why not buy them at 25 cents or 28 cents or whatever the price is? So it ends up being a really nice incentive mechanism for these traders. And there's also this, if 20% of profits will be basically spent buying and burning flex coins in the order book. So that's another component as well that helps. Is this buy and burn basically.
And I think we'll end here on what I find to be super fascinating. If you can give us kind of a quick back of the envelope look here into your neologism, your IFO, your initial future opening, and kind of tell us what that's about.
Yeah, absolutely. So CoinFlex, we just basically are trying to solve market problems with derivatives. That's kind of what gets us out of bed every day, and what we love doing, and our passion. And my co-founder has had a long career basically doing that in the traditional space, and I've been trying to do that for 6 years in the crypto space. And so we both just love solving problems with derivatives. IFOs are one way we're trying to do that, which is basically there's a lot of these projects which haven't launched yet. And there's a lot of smaller customers that would love to buy them but can't, because they're basically only available to high net worth individuals because the coins haven't gone live yet. So there's these complicated legal contracts, and it gets very messy, and it's often only accessible to high net worths, basically rich people. And there's all these larger investors that maybe have purchased early and would love to hedge. And so we wanted to make a market for these people to kind of interact. And obviously it's an initial futures opening is basically a term we're using for a futures contract on a coin that doesn't exist yet. So in the first case, we did Polkadot, and tomorrow we're doing tomorrow, which is I don't know when this is going out. So, and this is in different time zones for you and me. So Thursday, the 22nd, we're launching Definity. And these are both coins which are doing very interesting things, very new, and kind of very technologically advanced projects that have a lot of private buyers, a lot of people investing in them, but they haven't really been tradable publicly yet. And so we're obviously not listing the coins themselves because they don't exist.
Right.
We're listing futures contracts on those coins, and the way we margin that and the way we kind of are able to handle that is by over collateralizing anyone who's shorting the coins, because obviously the risk is if the coins go up massively in value at the time of launch, then we're not going to be able to supply the coins to the
right.
Yeah, so that's kind of the way we're handling it. And yeah, I mean, it's been super exciting. They're very volatile products. So especially on the first day, most of the trading happens in the first 2 days. For example, I think our Bitcoin futures traded something like $210 million in the last 24 hours. Wow. Our Polkadot futures, there's orders in the order book, there's bids and offers, but the 24-hour volume is zero, which doesn't mean it's a failure. That just means right now, most of the trading volume happens in the first 24 hours.
Right.
So that's kind of how people are interacting with it, and it's pretty typically a very, very exciting 24 to 48 hours. It's just lots of volume, lots of trading, and yeah, that's kind of, and then thereafter it creates sort of a market price for the asset where people can say, okay, cool, if I have private agreements for this asset, I can now know the mark-to-market value of the asset itself, and that's very useful to the market as well, even just as a signaling mechanism.
Yeah, it's unbelievable, and it's a way in for those that didn't get to participate, sort of as either accredited investors or what have you. So yeah, just a brilliant idea. Again, man, I cannot thank you enough for coming on. Maybe next time I'll talk to you a little bit more about Hong Kong and things that are going on there. And I definitely want to get your take on Bakkt and some other things. But in the meantime, man, I'm going to let you go and enjoy the rest of your day. I know you're extremely busy. But where can people find you and find your work and follow you?
Yeah, absolutely. No, thank you so much for having me on. Always a pleasure to come on the show. You can find more about CoinFlex on the website, coinflex.com, our Twitter, coinflexdot.com, and then me personally, I'm basically Mark David Lamb on everything. So Mark David Lamb on Twitter and Telegram, and both are pretty great ways of getting a hold of me.
He is a guy to watch in the space and doing some incredible things, as you've heard. Again, I can't thank you enough for doing this. It was very last minute. Thanks again, man. Appreciate it.
Thanks a lot. Thanks, Kelso. Talk soon. Bye.